welcome back, everyone. I'm just going to have to lean down into this mic. I think this was set up for Chris. Chris Eddy, not Chris. Welcome back.
Thank you very much, Michael. Good morning, ladies and gentlemen. I hope you are enjoying the conference thus far. I think the sessions we had before the tea break have been quite insightful. And thanks again to 10X as well for actually inviting us and inviting me and actually trusting me to moderate this panel. Right, so the topic for this session is building resilient portfolios for better outcomes during uncertain times. I mean, we will all agree that this year in particular has been quite a ride in financial markets, and it is quite a challenge to actually figure out a way to navigate those challenges that the volatile markets create for building portfolios. So I'm joined on stage by a group of very seasoned individuals in the asset management space. Let me start with the ladies, because we've got two ladies for a change on stage. Right on the other end, we've got Victoria Reuvers. She is the MD of Morningstar Investment South Africa. And to her right, we've got Florbela Yates. She is the head of Equilibrium Investment Management. And then we've got two gents. We have Paul Fouché. He is the CIO and co-founder of New Road Capital. And last but not least, we've got Chris Rule. He is the head of client solutions at 10X Investments. Thank you very much for joining me, ladies and gents, on stage. Let the games begin. All right, so the topic is about building portfolios, resilient portfolios for outcomes in order to achieve better outcomes. But before we actually delve into the topic, let's maybe just start off by explaining from your perspectives, what types of outcomes are you actually building your portfolios for? So Chris, maybe let me start off with you.
So it's an interesting question because I'm sitting on a panel with clients here and we're building and helping them build the outcomes themselves. But I mean, I think, look, you guys heard from Anton and Chris earlier, at the core of our value proposition is a range of multi-asset portfolios which look to deliver consistent outcomes by allocating within a strategic and risk-managed fashion. And I think that consistency of outcomes that plays into better client outcomes at the end of the day, and the client centricity around that consistency is core to our business value proposition. Why I say it's interesting is because we're actually managing more third-party multi-asset funds than house-branded multi-asset funds. And you can see how we integrate ourselves into their processes from input into asset allocation through to implementation and to actually housing those funds on our infrastructure and manco. That outcomes can be built in many different ways, and there are a lot of unique outcomes in the market. And we're starting to see Cat 2 asset managers, multi-managers, advisors, family offices actually start to build genuine outcomes that are aligned to their client objective, from US inflation targeted outcomes through to, Paul is sitting next to me. They've built a very specific asset allocation outcome with exposure to high growth engine and offshore markets. And so I think what we are trying to position ourselves beyond what Chris and Anton spoke about in terms of our house view multi-asset portfolios is for clients to come and use us and leverage our infrastructure, leverage our capabilities to build those very specific outcomes that can't be found on the shelf. And I think that's an interesting perspective and something that we can unpack further. But it's not a one size fits all, right? And those unique needs are something that we're trying to cater for in the market.
Okay, perfect. Thanks for setting the scene on that. So for you, it's more bespoke outcomes that you can tailor-make for your clients.
Correct.
Fabulous. Let's move to Flof.
So for us, we can also build for whatever the advice outcomes are. We actually, for our own portfolios, follow an outcome-based philosophy. And I'd say that most advisors in South Africa tend to look for an income solution, and then they're trying to generate real returns for advisors, for clients. So they would typically have some CPI plus outcome that they solve for. So that's probably where the majority of the outcomes are that we solve for. But on a bespoke basis, we can actually solve for any outcome that the advisor needs. So some examples, we've had advisors that have asked us for cash plus returns when their books are mainly retired clients, particular income drawdowns. And again, those outcomes are often linked to a time horizon. The time horizon would be different for different advisors. And then we've even been asked to solve for particular risk budgets. So the outcome is really dictated mainly by the advisor. And off the shelf in the local world, it will be mainly CPI plus linked. For our hard currency offshore models, it's typically linked to either an index, where advisors have a strong preference to use a listed index, or it could be linked to a basket of currencies, and then it's a global cash type outcome.
Okay, thank you. Vicky, from a Morningstar perspective, anything maybe different from the two panelists?
Probably just to say we look at three broader buckets. So pre-retirement money, which would be CPI linked, post-retirement money, which is typically income focused, and then discretionary money, which is really your hard currency, offshore money or long-term growth assets. And then within that, I guess the capability to create either fee cap portfolios or maximum drawdown portfolios. But yeah, nothing too new other than what the other panelists have said.
Okay, great. Paul, I need to check with you. Anything different from your end?
Yeah, we have a couple slight differences, I suppose. We do, similar to Florbela, we offer the majority of our portfolios are outcomes-based targeted portfolios, so inflation plus portfolios. What we're trying to do there is limit or manage volatility where we can. We're dealing into the IFA space, and obviously you've got the retail client at the end of that who's not a professional investor. So volatility does actually have there is a meaning to volatility when you're looking at, widows and orphans and retired people. So we try to, not that you can get rid of it, but you're trying to limit that volatility, and obviously trying to you look at inflation plus targets, because that's what the IFAs use when they're sitting down in front of a client doing an F&A. Where we differ slightly is we don't see ourselves as we're not a DFM, we're an asset manager, but we're not stock pickers. So what we do is all our quantitative work goes into asset allocation. So we've got a couple propeller heads in the background that are running portfolios on a quantitative basis, but using building block asset allocations. So we'll use across equity, both global and local, we'll use rules-based allocations. The only space we'll use active is actually in local income. And that's just because the markets, you can't really get passive solutions for a lot of those products, a lot of those investments. So that's essentially where we see ourselves. So I suppose slightly different, and that we're an asset manager, but looking at using asset allocations rather than stock selection to get our outcomes.
Okay, great. Now that actually brings me on to my next question on asset allocation. So thanks for bringing that up, Paul. So we are currently in a fairly high inflation and interest rate environment globally, and I suppose a high interest rate environment locally. This clearly brings, various challenges from a portfolio construction perspective. So perhaps maybe to the other panelists, from an asset allocation perspective, how does this environment that we currently find ourselves in determine your asset allocation process? Floor, let me maybe start with you.
So the biggest volatility, portfolio volatility, actually comes from your asset class. So we actually use strategic asset allocation as the cornerstone of our process. So we also use a building block approach. And all the research we've done shows that getting that asset allocation right is the biggest determinant of the outcome, actually both in the short and long term, but obviously in the short term there's a little bit more variability. So we focus on the long term, and then what we do around that is we try and understand the drivers of returns and the implications that'll have in different market cycles, but we tend to take a longer term view, and the long term would be the horizon of that particular portfolio. So strategic asset allocation is the cornerstone. We do then, in very volatile times or where there's a mismatch in the markets, and there are opportunities to take advantage of that, we would use some tactical calls, but it's always at the margin. You don't want to erode all the work that your strategic asset allocation has done by taking huge tactical calls. But I think in the current environment, we're definitely seeing opportunities to make some tactical calls. And we have to be cognizant depending on how we execute. So in a model portfolio, CGT is a problem. You don't want to also do too many tactical calls that can trigger CGT. In a funds-on-funds environment, it's slightly different, and we've got a little bit more leeway. And I guess that would be how we would run most of the portfolios.
Chris, from your perspective, because obviously what you are offering is slightly different from the other three panelists, if you can please share your perspectives. Thanks.
So, I mean, just to put some spice into the panel, we don't believe that tactical asset allocation adds meaningful value in portfolio construction consistently over long periods of time. Fluff has promised to keep the assets with us, so so what we do see in the market is this clear misunderstanding that strategic asset allocation is static asset allocation. That holding an asset allocation in a strategic fashion means that you can't move it and you can change it. And I think Anton and Chris articulated how you can manage for forward risks, how you can manage for consistency of outcomes by strategically changing your asset allocation based on a number of capital markets assumptions, based on a valuation-based framework, and within the constraints of the environment that we see ourselves in. And I think these guys articulated that very nicely earlier this morning. So strategic does not mean static. It doesn't mean we set and forget, because we are managing for outcomes and we are managing for risk. But tactical calls where we see market valuation events that are going to drive alpha in the next 6 months is not the business that we're in. And so we don't use that as a tool inside of our portfolio construction set.
Okay.
Respond to Chris. The other thing, I agree. So it's not strategic doesn't mean it's static. So we do make assumptions which are forward-looking about what we expect from various asset classes and even certain strategies. But what we don't do is we don't change them all the time, but we constantly review them. And obviously different environments would dictate different ways to execute. That also then affects how we even execute on each asset class, whether it's passive or active. And then maybe one other thing that we do is when we build portfolios, we're very cognizant of risk. So our main aim as an asset manager is to actually keep our clients invested. We don't want them to disinvest when there's a little bit too much volatility. So I think it's actually another part of what we do is spend a lot of time with our advisor partners explaining to them what to expect from portfolios. So in times where the volatility has increased, like we've seen in more recent times, our advisors tend to not panic. They understand the process, the philosophy. And part of that risk management in the portfolio is actually we focused with a 95% confidence interval how much negative returns we're willing to take in each portfolio. And I think that helps the advisors in their advice process be able to keep their clients or our joint clients also invested, because I think risk is important. You can't look at just returns or outcomes without the context of risk.
Yeah. No, I agree, and I definitely see some confusion in the market around what tactical asset allocation is, and anything that's conceived as a shift in strategic is tactical, but it's not. It's managing forward 5-year, 10-year time horizons. So no, I totally agree with that, actually.
Maybe if I can also just add to the conversation, Zama, you talked about rates, interest rates, and we've actually been afforded, I think specifically outcomes-based managers who you're looking for an inflation plus target. We've been afforded an interesting opportunity at the moment because you've got yields both locally and globally that have real yields that are at multi-decade highs. I mean, if you just look on the local front, let's assume a medium-run inflation of even 6% in South Africa. Some of these bonds are yielding 11+%. You're talking about inflation plus 5 there before fees. That provides an interesting opportunity. And just to touch on what Chris is saying, so we all our modeling and all our work goes into asset allocation. We don't actually say we have a strategic or a tactical asset allocation. That's not how we look at it. What we say is, what's the end goal? Based on what you can conceivably get, and we actually start with bonds. So we actually start with what can you get out of bonds. Bonds are a lot more, I mean, equities are impossible to forecast. I'm just going to say it. Maybe you don't know that, but they're impossible to forecast. Bonds are a little bit more forecastable. You at least have an anchor to yield or a yield to anchor yourself on. We start there and then we work backwards. And as those opportunities change, we can then modify the portfolios. And that's how we look at it. So it's not, we don't actually think of it as a strategic or tactical. We think of it more as you're trying to get inflation plus 5, say, for a moderately aggressive client, a long-term investor in an RA. How do you do it? What's the best way to do it? Taking into account that you're cognizant of the volatility. Is, at the end of the day, when you're dealing with retail clients, volatility does matter. Yeah.
Yeah, maybe a comment. So I think we all say the same thing when it comes to asset allocation. We use words like tactical, strategic. The bottom line is asset allocation is a driver of our returns. See, Paul, I would disagree with you. I think you can, to a degree, forecast equity valuations. But the challenge for portfolios at the moment is, although we have great real returns from cash and bonds, the correlation between bonds and equities has increased to the point that they're no longer the protector or they don't reduce volatility in portfolios anymore. They actually add to volatility. So while you're getting compensated on a yield basis, you're changing the dynamics of the risk metrics of the portfolio. So it's become quite a challenge. But I think a strategic asset allocation, or whatever you want to call it, is just a great anchor that through the cycle, that we know that asset allocation is going to perform well over time if you get it right. And when it comes to volatility, I actually think and I've been in the market for like 20 odd years, 22 years, and it's never comfortable. It's always volatile. We're just at a very uncomfortable point in the cycle. High inflation, high interest rates, and it's been prolonged because of the 15-year sort of low interest rate environment we were in, but it's actually perfectly normal and it's good. So as uncomfortable as it is, it's just a different form of volatility that we haven't seen. And your strategic asset allocation is just your anchor that sees you through the volatile times.
I love the fact that you all don't agree. It's great. It's great to have that healthy debate. All right, so let's move on to another topic that's been, quite an important one over the past year, is this topic of offshore allocations, specifically in Reg 28 compliant portfolios. The shift from 30 to 45% is a drastic one. So before, 30%, I think most portfolios were very close to the 30% offshore allocation. But when you move the goalpost to like a 45% level, it does change the game in a big way. So there are quite a few things that we can actually unpack in this particular subtopic. So maybe let me start with you, Paul. Your views on offshore allocation. So first, let's start with this one. Have you increased to 45%?
No.
Why not?
For no other reason, not that we don't, we actually like offshore a lot. In terms of the way we manage money and the way we think about it, and the fact that we're trying to manage volatility to the extent that we can, the more offshore, bearing in mind, it depends on where you're investing, right? So, I mean, most of our clients are retail clients investing in rands, their costs are in rands, everything's in rands. You want to limit rand volatility. You need an asset liability match to some extent. If you go too high and offshore, you start to add too much volatility, unnecessary volatility. We don't think it's worth the volatility to go all the way to the 45. We like the fact that we can do that. If we had to have our way, we wouldn't have limits on asset allocation in a Reg 28 environment. But where we find optimal, depending on the risk profile of the portfolio, we kind of between the high 20s to the mid 30s would be our kind of sweet spot of offshore. So lower risk portfolios a little bit lower, higher risk portfolios a little bit more. That's where we found the sweet spot.
Okay, Chris, from your end, because obviously your portfolios are different from what Paul is doing.
Look, what the change in Reg 28 afforded us to do, which was I think fantastic for investors, is to further diversify our portfolios. Now, the diversification, to Paul's kind of comment, does come at the expense of additional volatility beyond a threshold, and that threshold moves around. But let's say it's mid 30s. So the way that we look at it is, can we control that volatility in some way? And we look at currency hedging as an opportunity to control that volatility. So, lock in the diversification, get access to global growth assets, and then control for volatility, which is critical in a time horizon-based investment strategy to create consistent outcomes through currency hedging. So we deploy currency hedging to control volatility that the greater Reg 28 limits have afforded us. so that we don't constrain our opportunity set ultimately. And basically what Paul had said is that currency hedge, the quantum of it is going to differ based on the risk appetite of the investor at the end. So less risky portfolios, less growth assets, more income-centric portfolios require more risk management, cannot stomach the volatility that the currency overlay introduces into the portfolio mix. And so there's a greater need for currency hedging and potentially, because we have such attractive real yields in the local market, a higher local to offshore split, which goes all the way out. Ultimately, through the cycle, we see ourselves going all the way out to 45%. We're slightly below that at the moment in terms of getting offshore exposure. So, yeah, I mean, that's...
Just maybe one thing on the currency. You do run a risk. You actually want to have, to an extent, you want to have naked currency exposure in your offshore. Exactly. You don't actually want to hedge most of it because in times of crisis, generally the rand will weaken, and if you position your portfolio correctly, we own a lot of developed market treasuries, specifically US treasuries. Those probably, to Victoria's point, in a time of crisis, that's the only asset class that actually have negative correlation to everything else. They generally tend to rally, or they have historically rallied, and you're getting a currency uptick. So you actually want to have that exposure. So you can add volatility, but so let's say normal long-run volatility will be slightly increased because you got the offshore, you got the currency, and you naked the currency. But in times of crisis, it actually works in your favor. So if you're hedging that currency, you don't actually get that currency kick from the weak rand. So it's also something you've got to play like, do you want to limit volatility in a normal market, or do you want to increase your odds of hedging in a bad outcome, which is actually why you're owning it?
Yeah. I mean, to be clear there, we don't hedge out our entire... I'm disagreeing with our clients way too much, Zama.
I would be worried if I were you.
Zama used to be our business development specialist, so she would be lashing me outside now. We don't hedge our entire currency block. We only hedge beyond a point. So like in high equity, it's beyond, say, 35% of... So we've got 35% dollar hard currency and EM currency exposure. Yeah.
Okay, fabulous. I actually just want to move on to another issue that has kind of arisen as a result of this significant change is, South African-based managers are now competing with a broader competitor base as a result of this increase in offshore exposure. So maybe, Vicky, from a Morningstar perspective, when it comes to manager selection for the global piece of the portfolios, is there any preference for either a locally based manager or a foreign based manager? What is the thinking around that?
So for everyone in the audience, I'm sure you know Morningstar, and we're a global business, and the backbone of our business is manager research. So we look at all managers through the same lens, regardless of geography. And I think, to give you a good example, we can find a fantastic fixed income manager based in Philadelphia, but you could in the US, Philadelphia in the US, but you could find an amazing global equity manager based in Stellenbosch. So geography is really just it's quite meaningless. I think as the world has opened up to such a degree, it plays less and less a part. Having said that, just in terms of the quantum of managers that exist globally, the universe is so much bigger. And we appreciate the cost and, manpower it takes to build a great capability, and we also appreciate that there's a shortage of skills and talent in South Africa. So it's not to say that there are not talented, brilliant managers who can run global portfolios that are based here. It's just they've got some headwinds. And so we look at all managers through the same lens. We invest with some domestically based managers for our global equity and then some global managers. And I think I'll give you just a nice example. One of our local global managers was flagged in our US research team, and they reached out to me to say, we can see the research report. Can you just confirm what's said about the parent? It feels so strange that they were born in South Africa and now they're making a big footprint in the US. What's your view? And so that's a great story, actually, how that happened. So yeah, we do have exposure. And I just want to say one thing on the Reg 28. whether it was a mistake, it was a gift from government, so we'll take it. I mean, the industry, we all thought it was a mistake. It couldn't be, but it's amazing. So, for all the people who are very negative about SA, it's a good reminder that actually we have such a fantastic investment industry and financial institutions that the direction of travel is positive.
Okay, no, thanks for those insights, Vicky. And then, in the global space, we've also seen quite a few strategic partnerships between South African-based asset managers with foreign-based managers. So, I mean, recently, Flo, from a Momentum perspective, Robeco partnered with Momentum. In the past couple of years, we've seen the likes of Aluwani teaming up with a Franklin Templeton. We've seen a Stanlib teaming up with a JP Morgan. So we're seeing more and more of these strategic partnerships. From an equilibrium perspective, to what extent does that maybe, filter into your asset, your offshore allocation specifically? Is it something that you consider, or do you still prefer to go out and just select your own managers?
So look, I think Regulation 28 has created some opportunities, the changes. So the first opportunity that I think it's created is it's allowed us to look at portfolios more holistically. When you've got almost half, 45%, can now be invested elsewhere, I think it's given us at Equilibrium an opportunity to, instead of looking at manager research and portfolio construction locally only and internationally separately, we now have a much more holistic approach. So, for example, an example I can think of off the top of my head is where we source different strategies from. So I've already mentioned that when we build portfolios for certain asset classes, they lend themselves more to active, others lend themselves more to passive. That's one of the things that we look at. But now we can go a little bit further. So certain strategies. In the South African equity space, we've always looked for value, quality, and then earnings momentum or growth type strategies. We have now started thinking, well, if we're looking for similar strategies in the offshore space, do we have to source for the South African component from South African-only managers and the offshore from offshore, or can we actually source for it better? And I'd argue that something like quality, we've got such a small universe in South Africa, it's probably better sourced from offshore. And then you make the decision whether you want to execute passively or using rules-based approach or fully active. In terms of the strategic partnerships, I guess we have a similar philosophy to Morningstar. We look for best specialist managers across the globe, so they don't have to be based in South Africa. And we have a manager research team, probably one of the most experienced local manager research teams, that do a lot of the local research, but we have a team sitting in the UK that then does the rest of the globe. I think the advantage of that is that there's no way, in my opinion, that a research team sitting in South Africa can really look at that full universe. So we leverage off the two teams and we work together. In terms of strategic partnerships, we would consider Robeco one of the strategic partners that we certainly lean on them for information, but you can see that we use some of their competitors in our own solutions, manager like 10X, we rate highly. But there are opportunities, and I think maybe the only other advantage of having a global business is that we get access to specialist managers around the globe that most South African retail investors had never heard of, wouldn't be able to access because they might not necessarily be on a list platform. And we get access to them at very attractive fees.
Okay, great. No, thank you. So I suppose a panel discussion of this nature would not be complete, since we are at a 10X conference, without a discussion on rules-based investing. So I think let's maybe move on to that topic now. And just see how all of you incorporate, passive into your portfolio construction process. I'll end off with you, Mr. Rule, because they are your clients. So let's start with maybe Vicky on the other end.
So we really like passive. We like active too, but our starting point is always to build a portfolio with passive building blocks. So our domestic portfolios have around 30% exposure to passive, which can vary 30 to 50, and our global portfolios have a much higher allocation to passive. And We use passive for a number of reasons, but the first is it gives you a very predictable outcome, a very cheap entry point, and it gives you broad diversification of an asset class. It's particularly attractive if that asset class is cheap. Then you just get nice broad exposure. In an expensive market, we actually prefer active managers. And the problem we have, and just openly in South Africa, is platforms are a big hindrance for us. I wish I'd been listening in the last thing. I would have had lots of questions for those guys. But in terms of loading portfolios, whether it's ETFs or whether it's giving us that toolkit of access to passive, but yeah, broadly speaking, we would build a portfolio with 100% passive and then add active at the points where we think active managers could add additional alpha.
Okay, great. Flof?
We use a combination of active, passive, and smart beta or rules-based. Again, it's where we're sourcing the strategy from, and it is asset class dependent. It's also slightly different if we're building local portfolios with an offshore component, the Reg 28 space, or where we're building hard currency solutions. So in the South African market, we tend to actually, or we have until recently, mainly access the offshore through passives, and that's because, as Vicky said, the platform constraints. You typically have to invest in a collective investment scheme. So if you want to access offshore on a local platform, you've got to pay a feeder fund fee, and after fees, you nearly always underperform by going through those feeder fund into active. So accessing it passively or through smart betas would be much better. But for our hard currency solutions in the offshore space, then we tend to have a much broader universe. So there we'd use a combination of active and passive. And we've also tended to use more passive in the offshore hard currency, but in the equity area, we've used much more active.
Sure.
How potent passive can be. Our US team built a global multi-asset portfolio, 100% passive. It smashed its benchmark for 8 basis points.
Oh, wow.
So that's just the power, I guess, of broader markets that also allow for platform build. So, yeah.
Paul,
Yeah, so we run all of our portfolios through CISs, so either funds or single strat funds. So we can go and invest in ETFs. We don't rely on what's on the lists. Predominantly what we'll do is maybe also to touch on what we were talking about earlier. We use a lot of, actually on the offshore side, we use a lot of thematic based ETFs as well. So it's rules based. You could call it passive. It might be exposure to semiconductors or to NASDAQ or something specific like that we like. But predominantly we will start pretty similarly. We'll start with a broad market cap based index, and then we'll work back from that. All of our asset allocations are passive or rules based, let me say, except local income. Local income we use active managers just because it's for us the only place where you can get sort of consistent outperformance versus a passive benchmark. Even if the passive benchmark is not necessarily investable, but it's the only place where we still think active managers consistently outperform. You can get you will always have outperforming active managers, but the consistency is the key for us, and that's why we use a lot of passive as a building block, and then thematics, and that's a nice thing with ETFs now, especially offshore. You've just got a proliferation of options. You don't need to go and pay an active manager to get exposure when you can make a call on, for example, NASDAQ, or if you like semiconductors, go and get the full suite of the semiconductor value chain. That's how we build it out. Low cost, pretty transparent. You know what it's doing. It's rules based. Yeah, that's how we do it.
Okay, great. Thanks. Chris?
Yeah, I mean, look, I think the word passive has been the propaganda of the century from the active houses because, I mean, what you hear is that it's anything but passive, right? This is index-based investing, rules-based investing, call it what you want, but it's definitely not passive. I mean, one critical piece is this broad categorization of passive is just so off mark. I mean, take SA equity. Some of our passive strategies are the most active in the market from an active share measure and so forth. So I think, yeah, I mean, we use index-based, rules-based strategies predominantly, where the market type is appropriate. So liquidity is typically a driver of that. I mean, if you go into the less liquid, say, credit space locally, you simply can't access it via an index. So you can't invest passively. And I mean, I won't say anything more after Vicky's comments. I'll just stop right there. Thank you for the. but like quality is a great example. So we were talking about like valuation. Vicky spoke about valuation actually, and she said there are points in the cycle where valuation is perhaps stretched in vanilla beta, and it's been stretched by a handful of companies, and so therefore the outlook is from a return expectation is a low probability of CPI plus 5 or 6 or 7. You can actually use a rules-based framework to tilt towards quality businesses, and that's kind of what the guys were showing earlier. But that is an example of how there's so many tools at your disposal that are. It's not a passive decision. This is an asset allocation and a preference-based decision implemented through an index-based strategy or through a thematic-based strategy. It's not one size fits all, and I think. The industry, and we've been guilty of it, but the industry has been guilty of trying to say, well, everything that's passive is just here, and then look at all these choices in the active universe, because that's absolutely not the truth.
And maybe the next question is really for anybody who wants to answer, because I see we are starting to run out of time, is just your views on exposure to alternative assets or asset classes in general. Any of you utilizing those? I suppose for model portfolios in particular, it might be a bit of a challenge to incorporate some of those because they're not daily priced. But any comments on alternative asset classes?
So maybe I'll go, because we definitely believe that we should be using all the tools in our toolkit, and alternatives definitely are one of those we'd like to have exposure to. You can hear that Vicky and I talk a lot about the constraints on platforms. So there's so many different alternatives, and alternatives can be used not only to increase your alpha or outperformance, but also to manage risks. I think there's definitely a place for alternatives. In the South African model portfolio world, we restrict it. So hedge funds, and certainly retail hedge funds, are now becoming a little bit more mainstream. But even if you look at which funds are available on different platforms, they're not always the same. So that's a constraint for us. We'd love to have more exposure to alternative strategies or different types of indexes. But again, ETFs are constrained. I think there are only 3 platforms in South Africa that currently allow you to use ETFs. And again, they're quite restricted. But then there are other alternatives that in a model world we can't use that we can use in a fund of funds world. Remember, we run both. And those would be things like infrastructure, private debt. And you can't really use those in the model world because they're not daily priced, they're not available on platforms, and they're not wrapped in a collective investment. But certainly, where we can use them, we are making use of them.
Can I just make one comment on alternatives? Is that it's this chicken and egg scenario. So in the retail world, we have daily pricing and liquidity, which is the dream. But that also shows volatility, because the reality is, to give the Warren Buffett example, if your house had a price on it every day, you'd panic when you would sell it at the low points. But the fact that you don't know what the value is, it's a great long-term investment. And so the attraction with a lot of alternatives has been the lack of liquidity and therefore the lack of perceived volatility. And it is just perceived volatility. So you've got this trade-off, and they do play a fantastic role in portfolios. But practically, when we're in a world that requires daily liquidity and pricing, it does preclude a lot of those instruments, which I don't think is necessarily to investors' benefits, but those are the rules of the game as they stand.
Yeah, also, we're also big fans. Anywhere where you could get diversification, you should look at it. But also, there's some regulatory hindrances. If you look at Reg 28, you can only have 10% of your portfolio in alts, for example, 2.5% per manager. 10% in a portfolio is not really moving the needle too much. If you just look at it quantitatively, you need quite significant diversification in order to see much of it. You'll see a change, but I wouldn't call it a meaningful change. So there's some regulatory issues as well that I think need ironing out. But definitely things to look at in a portfolio. On the CIS space, we're also limited from a regulatory point of view at the moment, is that you can't actually own an alternative or a hedge fund inside a CIS at the moment. So that's also a limit on our side, would be the regulatory limit.
And then just the last question, because I don't see any questions on Slido at the moment. Is it the crowd? Huh? Okay, because I just checked and I didn't see any questions, but I've got one last question for the panel. Again, anyone who is keen to answer. So just in terms of ESG or responsible investing in general, there was quite a bit of hype about it. It seems to have quietened down. I'm not quite sure why, but there was a time when we had many ESG-related funds that were being launched in the market. What are your views on ESG and in general from a portfolio construction perspective? Is it something that you seriously consider when you are, reviewing managers, for example? Any thoughts on ESG in general? I know it's a very broad topic, but we've got about 5 minutes or so. Vicky, I know.
Sure. I've got a lot to say on ESG. So Morningstar at our core is a very sustainable business. We bought Sustainalytics. We focus on ESG. We're very loud and proud in the media about it. A couple of points. One, it's always distressing when a theme becomes popular because it's opportunistic and you get these fad fund launches just in the pure dream of gathering assets. The ESG did very well because what is very ESG friendly? Tech companies. Going into 2020, and then post 2020, what's very un-ESG friendly? Energy. So you had this, this performance-driven, fad-driven flow of money into ESG, and then the whole thing collapsed in 2022 when interest rates rose and tech did poorly. And then everyone said, no, I don't care about ESG, I just want returns. The reality is our role in South Africa, if there was ever a country that ESG was prominent, just think of state capture, everybody. I always say people point fingers at governments, but they should be pointing fingers at the corporates on the other side of that. And it was all of our role, from asset managers to corporates to civil society, to actually place that role. So ESG is broader than just a theme. And I think I speak for everyone on the panel here that when you talk to managers or if part of your process, ESG is a risk factor. So it is, everybody will have it incorporated in some form or some shape or form. And if they don't, they might get into trouble because it is a form of risk. So however you incorporate that into your valuations is essential, but our goal is ultimately to derive long-term sustainable returns for clients, and that means investing in companies that are sustainable in the long term. So it is, I think, going to be here forever. It has to be, but it's going to take different shapes and forms. But it's quite a good thing that the craze has died down, but now we've just seen it move to AI. So, one goes, one pops up. In short.
For us, when we look at managers that we use, we do a very similar approach. We have to have sustainable managers, and doing the right thing and investing in companies that are sustainable is going to make sure that they're around for the long term. And that's what we're trying to do. We want to make sure that they're around to look after clients' assets. So for us, it's more important that what the asset managers are doing on ESG is reflected and integrated into their portfolio. Any asset manager or any of us could sit here and say, yes, we take ESG seriously. And then when you see the companies that we invest in, they're not socially responsible, they don't have good corporate governance, and they're invested in industries or areas that are not environmentally friendly and actually harmful. So I think you need to make sure it's integrated. It shouldn't just be a theme. It should be something that you can actually measure in the portfolio.
So I've got one last comment on that. People hate companies or industries. Oil's bad, mining's bad. But what about the S and the G part of that? What about the communities that thrive and survive from mining companies? And so if you've just got to make sure that they do it in a sustainable manner, but there's this very broad brush that tarnishes just certain industries, and it's much broader than that. So as Fluff said, you've got to get deep down. What's a manager's approach, and are they applying it consistently?
Yeah, I would say it's slightly different, maybe a bit more controversial. The concepts behind ESG, you can't argue that the intentions behind it are good. Problem is when you start centralizing the term ESG, and you've got 9 or 10 rating agencies in the world that are arbitrarily assigning what goes to what score, it very quickly, and it starts to become centralized, it very quickly becomes a greenwashing exercise. And I think that's what we're talking about now. You've got a lot of companies out there, specifically the ones with the big budgets, who can put whole departments onto filling out paperwork and looking good in terms of an ESG score, whether it's Sustainalytics or Moody's or S&P or whoever the regulator is. And they'll go and, talk up nicely to all those regulators and do what they have to do, and they'll get a nice ESG score. Means 0. Doesn't mean anything. So, We think the beauty about markets, the beauty about capital markets is that you have free exchange of capital. You have market. The whole point of a market is to have free movement of cash and free movement of capital. And I think what ESG, like I say, just to delineate what it's trying to achieve, which I think is noble and it's good, to what's actually happening in practice, it's creating a dislocation in the markets because you're getting a lot of capital going into ESG funds, and it's rewarding businesses who have budgets to be able to go and greenwash and do. I mean, take Apple for example. Apple's got a high ESG score. Apple's got, in some of its factories in China, it's got suicide nets outside the factories to try and stop some of its employees from jumping off and trying to kill themselves. I mean, if that's ESG for you, cool.
It's a different perspective. Thanks, Paul. 45, oh no, let's say 30 seconds, please, Chris, if there's anything that you wanted to comment on.
Yeah, I think we forget that we are stewards of clients' capital sometimes. And so where we see the integration of ESG critical is, to engage with companies, to vote proxy, and that's broadly across markets. We want to be long-term holders of equities, for example. And so to engage with companies to broad, admittedly, 5 years ago, we didn't vote proxy. We didn't vote on company issues. We've gone through the gears into just a vanilla governance policy all the way into a sustainable policy in terms of how we vote, engage. And ultimately, the privilege that we've been afforded by our clients is that ability to go on a meaningful capital base and vote and engage with companies and try to adjust behavior, corporate behavior in society, so that ultimately our clients benefit from that. I think that is a broad approach. It's not, the temptation was obviously to launch 100 ESG funds so we could raise money, but
it's a good way to raise capital.
Yeah,
It's a great way. Ask Larry Fink.
Okay, great. Thank you so much for sharing your insights so freely. I loved the debate that we had. That was great. Thank you so much, ladies and gentlemen. And I hope you also found the session valuable. Next session, I would like to introduce Michelle North, who is the head of financial intermediaries at 10X Investments. She is going to introduce her panel crew. Thank you.